Hello traders, and welcome to our next in the series of Compare and Contrast. Before we get started today, I'd like to ask a favor of you. If you find these to be of value to you, if you find them to be interesting, please hit the like and subscribe down below. Give me a thumbs up if you would. That means a lot, and it also helps me kind of know that, yeah, I'm on the right track. This is stuff that's helpful. It's stuff that's interesting to you. It's stuff that helps you on your options journey. And of course, that's what this is all about. Now, if you haven't yet seen the prior compare and contrast, I'd urge you to go back and take a look at it. In that particular one, we compared a short put to long stock. And as you may recall, a little spoiler alert here, the short put, they had very similar risk profiles, meaning that you were risking virtually the full amount of buying 100 shares of stock. For example, in the case of SPY here, you would have had $45,000 at risk. Now, of course, SPY isn't going to go to zero, but if you sold a short put, you'd taken a little money for selling that put, so your maximum loss might be a little less. Maybe it would be $44,000. But regardless, we showed how the short put is slightly less risky than owning the long stock. Now, all that said, today we're going to look at long stock and a long call. Okay, so when or why would you use one over the other? So basically, what you need to understand about these two and the differences between these two, I'm just using SPY as an example here. And if I were to go out and buy 100 shares of SPY, I'm going to spend $45,000 to own those 100 shares of SPY. And my risk goes all the way down to zero. Again, SPY, of course, isn't going to collapse that way. Certainly not going to go to zero. And if it goes to zero, we got bigger problems. Let's put it that way. So regardless, there is some significant amount of risk in owning 100 shares of SPY, or there can be. I mean, obviously, the way our markets have gone, it's not a massive amount of risk right now. But what you're going to see here is there is a way that I can benefit from those up moves without taking that massive downside risk. But there's a trade-off for that we're going to take a look at here. So again, if I go out and I buy 100 shares of SPY, it's going to cost me $45,000. Now, I can buy a long call that represents or acts largely in the way that 100 shares of SPY is going to act, and I only have to spend $680 for that as an example. In this particular case, I'm looking at an August 18th expiration, and I'm buying an at-the-money long call. This is 20 days out into the future. And if I take a look at that, I'm spending $678 to $680 for that long call. And so again, that is my maximum risk on that long call. My maximum risk is the $680. So long calls can be a very good way to partake in a bullish market without having the massive risk of a big downside collapse of a COVID situation or some sort of other event, Russia doing something unexpected, whatever the case might be, something that would cause our markets to move down rapidly in a short amount of time. If you have a long call, you have removed the risk that you would have here with your long stock. Again, your maximum risk is what you spent on that long call. But yet, if the market were to go up to 475, let's just say, I could be up $1,600 in this trade. Over here, we go up to 475. I'm up a little bit more. I'm up $2,200 in that trade. Well, what is that difference between the $1,600 and the $2,200? Well, of course, it's that $680 that we spent. So basically, we are spending money that is going to decay, and we'll talk about that in a moment, over time if the market does not move on us. So you have to be a little more sure or a little more bullish in this particular case. You have to get above $458.80 before this $680 goes into any sort of profitability in this case. So again, if our market right now, our market's trading at 452.20, we can see right here. So that's where the market's trading. I'm buying a 452 call. So by doing that, I am saying essentially, based on my actions, I have an opinion that by August 18th, SPY is going to be above $458.80, somewhere up in here. If I didn't believe that, this would not be a trade for me to make. So that has to be my opinion in order to be profitable on this trade. Now, what I want to look at here specifically is I want to come in and I want to take a look at theta, okay? So in our long call, we have theta working against us. Theta is time decay. So basically, every day that I am holding this position, again, we're 28 days out, I'm losing approximately $14 in value if the market doesn't change, if everything else stays the same. That's essentially what's happening here, is that this position is going to be decaying out from under me. I bought something that I'm expecting to go up in value, and I'm expecting it to go up in value above $459 in order to be profitable. And if it's not doing that, if it's just kind of sitting there, we can take a look here and we can see when we open this position, we're right here. As time marches on, if the underlying does not move forward in price, see what happens to our T0 line. As we get into this thing 17 days here, if the market does not move up on us, we're going to be down $288. Then another few days forward, we're going to be down $477. And before you know it, we're going to be down our full $680 if the market never moved one direction or the other. If we own the stock, however, and the market stays at that same price, well, we haven't lost any money. We're still at the exact same point because there is no theta decay in owning stock. All right, so that's probably the biggest takeaway here, is you don't have time decay because you're not dealing with an option. So when might you use something like a long call? Well, I can tell you that I have pretty good success using long calls off things that I think might move somewhat explosively. More than what their normal move might be. And also, I tend to trade, if I'm going to use a long call, I'm going to use a long call that's going to be much further out in the distance, generally speaking. And again, the reason for this is that theta decay is much, much slower per day if I go way further out in time. So let me just take a look at this. So if I have an opinion that SPY is likely to have some explosive moves to the upside, I'm not saying I have that opinion, but if I did, I mean, I could come all the way out here to I'd even go further out. These are what are called leaps. I'd go out to January of 25, and notice what happens. Theta decay dropped to $6.43 a day. So theta decay is much, much less in that scenario. However, look at what I'm paying for that option. I'm paying a lot higher amount of money for that option. I'm now paying $5,400. That then means that my break even is now up here at 504. So now if I'm going to make a trade like this, I have to have a mindset that by January 2025, I would expect SPY to be above this break-even amount of $504. Now, again, the benefit here is if the market were to collapse out from under me, drop down to, as our markets have done many times, where they've dropped almost in half, let's just say our 450 becomes 300, well, I'm down my 5,400. So over here, 450 becomes 300, and let me, well, I can't even go that down to 300 here. But if that were to happen, I mean, I would be down, I don't know, $18,000, something like that. So again, I have the full risk here. I don't have the full risk here. I'm only risking what I paid for it. However, there's a hurdle I have to get over here to the upside. So again, the point being that I really only want to do this if I think there might be a pretty significant and explosive move. And for me personally, I'm only going to do that in a leap format, a long period option, where my theta decay is a lot less. So again, if we take our time and we march our time forward here, here's our entry day, and I go, let's say I go, 15 days in or something like that, because we're so long dated here, 15 days in isn't very far. I go 15 days in, well, I've hardly lost anything at that point. 15 days in, and maybe I'm down $100, something like that, if the market doesn't move. I get a year into this thing and the market still hasn't moved. Well, now I'm down a fair amount. But in a year, it's highly likely, if my premise is somewhat correct, that the market would have started its up move by that time. If the market has not started its up move in a reasonable amount of time, and of course everyone has to determine what reasonable amount of time is, but if I'm not seeing my signs anymore that the market is moving up, I'm probably not going to be in this position a year later. I will go ahead and bail out of that position after 30 days or so, only being down a couple $100, if I'm not seeing the movement that I would like to see. So the big takeaway here to me is that you want to look for something that might be explosive. Now I'll show you an example here of one that I got into. I may have shared this example previously. This is Avgo. Some people call it Broadcom, or it used to be Broadcom. And Broadcom had a pullback in it a number of months back where it had some bad earnings, etc., and it had dropped from $600 down to around $450. Now, I felt that the company had a strong future. I felt that it was likely to move up fairly significantly in the next year or so. So I was willing to go in and take a bite on this thing. And Avgo was trading at $450. So if I wanted 100 shares of this, I was going to have to spend $45,000. Now, this stock is a little more volatile than SPY, which means that I'll have to pay a little more for those long calls, which I did. I paid $9,800 for a long call. Now, it did start moving up pretty quickly out of the gate, and of course the whole AI thing, which I didn't know about at the time, I got lucky on that. The whole AI thing started to propel a lot of these tech stocks faster, and that Avgo has now moved up to where I'm up about $35,000 in that position. So again, I was expecting some outpacing of growth because of the way it had pulled back, but yet overall its fundamentals were strong. Now these are, I should be clear on this, these are fundamental type plays. These are not unlike the wheel strategy that I just shared a couple days ago. These are things that if you're going to buy them as a leap, you're looking at a longer term commitment in most cases. So this is a little more of an investment type of play. Now, of course, you can come in, as we were looking at here, and you can buy options that are only out 15 days or, well, this is 56 days, that are only out, your 28 days, something like that. But again, you have to keep in mind that theta decay is much larger there. It's going to decay a lot faster. And so those are the types of positions that, again, if you're expecting a quick, fast move, there's nothing wrong with that. but in most cases it's difficult to predict a quick, fast move that might happen in a 2, 3, 4 week window. If there is an event like earnings, I should also state this, if there is an event like earnings, volatility escalates going into earnings, and when volatility escalates, the price that you will pay for that option is also going to be significantly higher. So to think that you can come in and buy a cheap long call just prior to earnings and then hope that those earnings go up, it's not going to happen that way. That long call going into earnings, when you have that question mark that's out there, people don't know. Are earnings going to send this thing 50 points higher? Are they going to send it 50 points lower? Around earnings, there's a lot of people that are greedily buying long calls, and they are buying long puts for safety reasons, and in both cases that activity drives the prices of both of those options, the long calls and the long puts, significantly higher. Again, if you have a premise, if you're pretty good at reading how earnings are going to play out, and you have a strong opinion of a big up move, and you're willing to pay a higher price to get that long call, it could still be a good move, but just know that there is no free lunch. You're not going to get that at the same price that you would get it if there was not an earnings announcement or a binary event. So that kind of summarizes our look at long stock versus a long call. And you'll notice also that the return, of course, is a much, much higher percent. If we come back here to this Avgo trade, where Avgo has not quite doubled. Again, I bought it at 450. I think it's trading, let's call it a double. It's trading at 900. Over here, if I own the stock, that would be a 100% return. Over here, because I only invested $9,800, this is almost a 400% return. So the return on your investment can be significantly higher when the trade goes the direction that you think it's going to go to, just because you can enter that trade for a much smaller amount of investment. So that's the big takeaway here, is that options can be used to accelerate returns, but you have to understand that you are paying that theta decay for that capability. So there's that trade-off there, and as a trader, that's part of your role, is to determine, is this just kind of a slow, steady mover that, and maybe it even pays dividends to where you're better owning the stock, or is it, I'm fine owning the long call. If there are dividends, you're not going to get them by owning the long call, so keep that in mind as well. And again, you can get a much higher return on this, but you're going to be paying that theta decay in the process. So hopefully this summary helps. Again, please hit like and subscribe if that's of value to you, and I appreciate everyone's time. Take care.